When a stock undergoes a split, the price of the chart before the split is adjusted according to the split ratio. However, the general outline of price action is not drastically changed in most cases. That is why price action before the August 22nd, 2000 split can be used to analyze the chart. This would be possible even if the split ratio was not 2:1, like in this example. A double top and triple top form a large flat top range to define a major long-term resistance range. This entire area is price action that has taken place prior to the split. That means prices on the chart have changed in accordance with the split, but the price action in terms of the movement is still generally the same, meaning the double and triple top were there prior to the split, but just shown in a different price range. This can be difficult to grasp at first, but the takeaway message is swing points and chart patterns can be used even after a stock split has changed the trading prices shown on the chart. In simple terms, normally nothing special needs to be done in terms of technical analysis of stock charts after a split. Just analyze the chart like you would if no split took place. And using swing points prior to the split makes little to no difference in most cases. Influence from the long-term resistance range is still in full force. A head and shoulders has formed with slanted shoulders. After June 21st, sentiment quickly reversed and a relatively weak upswing has risen back to the neckline, in the near absence of selling volume. A moderate bullish acceleration began to face opposition from downtrend lines taken from the head and shoulders swing points. The current bearish spike gaps down to end the minor bullish retracement in the large bearish context of the head and shoulders pattern, and the long-term resistance range marked at the beginning. It is normal to see a small upswing back to the neckline, but less common for price to push up further like in this case. This example demonstrates trend lines from the head and shoulders being useful in identifying more dynamic resistance if a shorter-term bullish move returns above the neckline range. In the medium to long term, the late June trip back above the neckline had lower bullish price action and volume compared to the red spikes before and after it, to exhibit classic characteristics of a bearish continuation. The downtrend lines are useful, but will diminish in influence, especially in the long term. The head and shoulders range continued to hold down AMD for years, but over a decade later, the initial upper resistance range is getting closer. A great example of a compact double top from September to October that sees the 3160 level from the shoulder level of the previous head and shoulders reused as the focal point of the double top's lower boundary. A case of a less strict triple top composed of one major downswing, in line with a more recent strict double top. 3160 can still be reused to mark the area of the more recent gap down level. Old neckline ranges offer strong support to the bearish surge, that is losing steam after short-term overselling. It is a quick reversal without directly touching the old neckline range. Also, here is another case where a gap opens almost directly on a previous level of significance. 3160 is a great demonstration of reusing a level to mark the approximate focal point of various formations that take into account past and present patterns. There could be some fine-tuning to mark a more precise range, such as with the recent gaps. But 3160 is very close, and that is why it is not entirely necessary to always adjust a level or range. Now a flat top has formed and a wider range has re-emerged under the long-term resistance range marked at the start of this example. 35 retains strong selling pressure from a large portion of market participants from all time horizons. That is seen with the still constant selling volume after the most recent bearish spike from early to mid-August. Once again, the old neckline range and the more recent gap up fill from April to May offer major support to counter the strong bearish sentiment in the mid-30s. Natural contention takes place at such major long-term ranges. Towards the end of 2019, bullish sentiment holds on, while selling pressure decreases significantly at the 35 level despite a few red spikes. Most of 2019 has essentially been a large horizontal range in the middle of a large bullish continuation. After almost 2 decades, the 35 to 47 range has reduced in bearish sentiment. It won't always be the case. A long-term resistance range simply diminishes over time. But this is one such case. Selling pressure was still very strong here after such a long time, but it was mostly concentrated at the lower 35 boundary. A break towards establishing in the 50s is more likely given the long-term uptrend and the short-term 3 methods rising price action in combination with the medium-term climate of relatively low selling pressure in the mid-40s compared to the mid-30s. It was a gradual rise to the 50s, but due to broader market forces during the major drop in early 2020, there was a delay in the climb back towards higher highs. Regardless, the old long-term ranges were still useful, especially the 38 to 35 range, where the pivotal upswing took place in March.